Good morning and welcome to Charting the Markets on Friday, the 24th of February. Let's begin by having a look at today's economic calendar, because at 1:30 p.m. we've got US personal consumption expenditure out. That's the PCE price index, which the US Fed prefers to look at compared to CPI data. And this is expected to come in at 0.1% plus 0.1% month-on-month rise for January, and on a year-on-year basis at plus 4.2%. And at 3 p.m. we've got the US new home sales for January, and we expect sales to rise to 0.4% month-on-month. But let's begin by having a look at the FTSE 100. And as we can see here, the FTSE has fallen over the last week, but then recovered yesterday, and today is really trading a very low volatility in volume. But what we can still see on this daily chart is that we have fallen out of this wedge formation here. As you can see, the orange line at the top and the line I just drew on the chart here, and that has negative implications. Also, the fact that we have a negative divergence on the relative strength index, so we haven't had a confirmation where we have a higher reading of the relative strength index on the oscillator down here accompanying the higher reading in the index, and instead we have a lower high on the relative strength oscillator here, telling us that we have negative divergence on the FTSE 100, which was a good precursor for those who wanted to get out of their longs when we made a new all-time high above the psychological 8,000 mark last week. Now, since then, we have come off, but so far we're holding above the January to February uptrend line. And the really important level to look out for at the moment is the 10th of February low at 7,850. Because if we were to fall through the uptrend line and that low at 7,850, then from a technical perspective, we would have formed a minor top at least. And that could then take us back down again towards the late January lows at 7,708. And failure there would mean that a medium-term top has been formed. So interesting times ahead with regards to the FTSE 100, but also with regards to the US markets. And today I want to spend some time on talking you through how I analyze financial markets from a technical perspective. Because basically, when we had the early February high, which was made on the S&P 500, and here you can see the daily financial bet, we could see that we had broken above the previous highs, basically the September highs and the December highs between 4,139 and 4,155. And as you can see here, that is this blue area. We managed to close above it twice, but quite often we try to break above it intraday and then we failed and we failed. So the upside breaks here were in effect actually false breaks to the upside, because we didn't follow through and then continue higher. Instead, we tried to break through this resistance area several times and then failed and have come off at the moment. And I'll get back to that in a minute. But before I do, what I would like to mention is you should always draw your trend lines in such a way that no price data goes through your trend line. So here, for example, we have the downtrend going back to January of 2022, and you can see there's no data going through that until we have the trend line break, which was made at the late January highs we made in the S&P 500. But as you can see here, that old downtrend line, because of inverse polarity, has now become a support line. And that's why we've held at current levels around the psychological 4,000 mark on the S&P 500 over the last 3 days. But also, very interestingly, we have held at the October to February uptrend line. And that's where we made the low yesterday on the S&P 500. And from a technical perspective, basically what we need to watch out for now is if we were to fall through the low from yesterday at 3,970, and also the red line here, which is the 200-day simple moving average at 3,940, then most likely there will be an acceleration to the downside, take us back down towards the December low at 3,764, and perhaps even take us back down to new lows below the lows seen in October at 3,491. So basically what I'm saying is we could be in for a phase of another down leg being made here with regards to the long-term downtrend, which would mean that the rise since October has only been a correction in a long-term downtrend, as you can see here on the weekly chart. So it's really important to watch out for what's going to happen with regards to the S&P 500 and other US markets in the days and weeks ahead. Now, why did I anticipate a reversal to the downside to be seen over the last few weeks? Simply because this new high breakout we saw in the S&P 500 wasn't confirmed by the other European markets, because by the other US markets, because if you look at the Nasdaq 100, you can see here it also rallied very strongly, actually by more than the S&P 500, but it did not manage to rise above its September high. So we went to 12,896 on this daily financial bet, but that was just short of the 12,902 high made in mid-September. And since then, we've just basically tried twice to break up this resistance area again, but every time we did so, we failed just below it, and have then reversed and taken out previous support, which was made up of the December high and also the 10th of February low, and have then now slid towards the red line here, the 200-day simple moving average, which is still being targeted. Because as you can see, yesterday we tried to bounce, but failed now in this previous support area, which because of inverse polarity has become a resistance area. So basically what I'm saying is that the odds right now seem to be pointing toward lower prices. And if we have a fall through the 200-day simply moving average at 11,892, that would most likely mean that we have formed a top here and that we are heading back down again towards the October and December lows, between 10,670 and 10,433 on the Nasdaq 100. But with regards to this high we formed at the beginning of February, it's not confirming the highs seen on the S&P 500. Well, what you could have also done then, which is what I did, you could also look at the Dow Jones Industrial Average to see whether that was confirming new highs. And as you can see here, the Dow didn't even come anywhere close to the December high. It went up to 34,516 on the daily financial bet, but it didn't go up to 34,941, which was the high in mid-December, and has instead since then fallen through the October to February uptrend line, and also yesterday intraday dropped through the low seen on the 20th of January, the last reaction low at 32,934. Now, if we were to fall through that level and also yesterday's low at 32,795, then the low seen in December and the red line here, the 200-day simply moving average at 32,474 to 32,383 would be next downside targets. And failure there would then probably mean a long-term reversal to the downside being seen, taking us back down towards the October lows at 28,630. So we are at a critical juncture with regards to US indices. European indices so far have fared slightly better, but are also starting to come off, as we saw on the FTSE 100. But basically, when you analyze individual indices, you should always look at them in context with other indices in the same country. We can do that in the US because we've got the Dow, we've got the Nasdaq, we've got the S&P, we've got the Russell 2000, for example, and see whether they're all showing the same breakouts or not. And if they don't, that is an early warning signal that perhaps something other than the continuation of the trend will be seen going forward. Now, I mentioned the PCE price index, which the Fed favors with regards to its forecasts and also to its interest rate policy and monetary policy going forward. And that is expected to come out later today at 1:30 p.m. in the US, and we expect prices to rise by 0.1% month on month for the personal consumption expenditure in the US in January, and by 4.2% year on year. Now, when you look at the impact this has had on, or this might have on the US dollar, we might see further strength pushing the US dollar higher. And here you can see the inverse, and that is the euro dollar. And as you can see here, all of this week, we have traded in relatively low volatility, but we have been falling for 4 consecutive days now. And we are heading back down again towards this key support area made up of the early December lows and the early January lows between 104.84 and 104.44. This is, for me, the next downside target area, together with the high seen in August of last year at 103.68. So as long as we stay below 108.04, which is the last reaction high on this chart, on the daily chart of euro dollar, the downtrend remains intact for this currency pair. And if you look at euro sterling, what we can see here again is a failure just below the psychological 90 area. And last week we tried to rise to 82.28 on this daily financial bet, but then formed a reversal and then had a very sharp decline on Tuesday, take us to below the last reaction low here, the mid-February low, and down to 87.84. And that means, since we've also broken through the December to February uptrend line, that the momentum is now pointing down again. So a fall through 87.84 would probably also lead to a fall through the 87.63 late January low, and then take us back down again towards the 87.22 mid-January low. So likely further downside to be seen with regards to euro sterling. Now, I'd also like to look at dollar yen, because this is a trade which has reversed its downtrend, because we have now managed to rise above and, more crucially, close for several days above this key resistance area made up of the early December low and the January high between 133 yen and 63 cents and 134.77 yen. And as you can see here, we dipped down into this resistance area previously, which now, because of inverse polarity, has become a support area, and we are bouncing off this area at the moment. And we did so on the back of the new governor of the Bank of Japan, Kazuo Ueda, basically defending the current stance of monetary easing, despite inflation in Japan hitting a 40-year high earlier today. And the annual inflation rate in Japan rose to 4.3% in January, and it was up from 4% in the previous month. So that's back to levels last seen in December of 1981, amid a rise in prices for imported raw commodities, and also amid this yen weakness we can see on this daily chart of dollar yen. So it looks to me as if we're forming now a medium-term bottoming formation, and since we've broken out of the midpoint of that bottom at the January high at 134 yen and 77 cents, the odds are now in favor of further upside to be seen, taking the currency pair back up again towards the red line here, the 200-day simply moving average at around 130 yen, and then also back towards the mid-December highs at 138 yen. So further upside likely for that currency pair. Commodity markets have also been impacted by the rising dollar as of late, and let's just start by having a quick look at the price of gold. And as we can see here, spot gold has declined from the beginning of the month and continues to do so. And we are once again, like last week, retesting this key support area short term between $1,824 and $1,810 per troy ounce. And we'll see whether we can hold here or not. If not, further downside may actually take us all the way back down again towards the red line here, the 200-day simple moving average at $1,776 per troy ounce. And this downside bias will remain in place as long as we stay above these last two reaction highs, and especially the high seen on Monday at $1,847. So as long as we stay below there, further downside is likely to be seen. And I'd like to finish up on the price of Brent crude oil, because this is really fascinating, because we've been trading in a sideways trading pattern since mid-November. And every time we basically came down, we sort of bounced off this December to February uptrend line, and have done so again yesterday when we dipped down to $80.30 on this daily financial bet and then bounced off again. And the question now is, will we be able to once again head back up again towards this key resistance area between $87 and $89, Or will we run out of steam like we did a few weeks ago in mid-February, and then eventually break through that uptrend line, in which case we would be heading back down again towards $75 and probably even lower towards the $70 mark also. But short term, the price of Brent crude oil is heading back up again. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is @AxelR_IG.